So indeed, as many of you will know, of course, the university and Chicago booth have a long tradition of informing public discourse through a variety of different platforms and events. And for Chicago booth, Economic Outlook is the oldest of these events. It began in 1954. And tonight's session is the third of three for the year, one each on our global booth campuses, Chicago in January, Hong Kong last month, and then here in London to cap out the series. And then at each of these events, we hope to provide a forum for thought leaders to confront the future, evaluate emerging trends, and share insights to help inform and perhaps even reframe our understanding of the world around us. So our program this evening is a 1-hour session, and throughout the conversation, we encourage you to submit questions. If you're joining us virtually, you know the drill. The chat link will be on your Zoom, so please provide your questions there. If you are in the room, you will see QR codes on the monitors, so you can use those QR codes, and our moderator, Mark, will have access to those and will infuse your questions into the conversation this evening. It is also worth noting that this year's London event is very unique and very special, and that we're delighted to be partnering with the university's Institute of Politics, or IOP, and we want to look at the EMEA region with a political as well as an economic lens. So the panel this evening will be exploring the links between these two dimensions and offering insights to business leaders as well as policymakers alike. So we're thrilled to have IOP's expertise, their partnership, their collaboration, and their perspective in shaping this evening's event. Here to say a few brief words about the IOP, as well as to introduce our panel, is Zinat Rahman, Executive Director of IOP.
Good evening, everybody. Let me begin by thanking Elizabeth and her wonderful team for being great partners and wonderful hosts on this lovely campus that I have not seen before. So we are thrilled to be here and to partner with you. The Institute of Politics at the University of Chicago was founded 10 years ago. It was founded by David Axelrod, who's a political strategist. And in keeping with the university's commitment to free expression, we are a nonpartisan institute. We are extracurricular, which means that we welcome students from all disciplines. Our mission is to really nurture the talent of the next generation of leader in politics and public service. And we think that those folks can come, and we hope that they come from many different disciplines, including the business world. And so another part of our mission is to explore the challenges and the opportunities related to democracy, of which there are many. And so we host resident fellows for a quarter at a time at our building in Chicago. We host events such as these, and we host conferences as well annually. We also give students an opportunity to get their feet wet in democracy by nurturing a lot of civic engagement and leadership projects. So on to the event for today. So according to Freedom House, the present threat to democracy is a product of 16 consecutive years of democratic decline. And I quote from their latest report, in countries with long established democracies, internal forces have exploited the shortcomings in their systems, distorting national politics to promote hatred, violence, and unbridled power. Those countries that have struggled in the space between democracy and authoritarianism, meanwhile, are increasingly tilting towards the latter. And so with that said, I look forward to today's conversation, which will explore the link between economic and political environments and what that means for indeed the economic outlook for 2023 and beyond. I'm not going to read our speakers' full bios. You will find them as you RSVP'd. You'll see their full bios online. But today's conversation is being moderated by Mark Landler, who is the London Bureau Chief for the New York Times. And our panelists are Randall Krosner, the Normal Bobbins Professor of Economics at UChicago Booth, Sasha Havlicek, co-founder and CEO of the Institute for Strategic Dialogue, and Jeff Curry, the Global Head of Commodities Research and Global Investment Research at Goldman Sachs. So with that, Mark, I turn it over to you. Thank you.
Thank you very much. And good evening, everyone, and welcome. I'm not going to repeat the introduction of these three. Suffice it to say that they're going to make my job very easy tonight by offering you all sorts of wisdom and insights, and I'll simply try to keep the conversation going. But before I do that, I will set the stage just for a moment or so. I think it's fair to say that rarely has a year started with the uncertainty that we see in 2023. War in Ukraine, now entering its second year, tensions between the US and China over issues like mysterious floating balloons and more serious matters, or perhaps equally serious matters, economic and supply chain disruptions around the world, a political near miss in Brazil that had distinct echoes of another one in Washington a few years earlier, a changing climate that dumped snow in the Hollywood Hills last week, but has dumped none in the Alps for almost this whole winter, and the start of a presidential election cycle in the United States that sadly promises to revive the fears of a threat to democracy that haunted the 2020 election. So over the next hour, we're going to touch on a number of these topics from both an economic and a geopolitical perspective. I think this outlook, as we've said, is somewhat unusual this year because it will have a strong political component. But the goal here is to try to shed light on a few key questions. Number one, are we in fact entering an era of deglobalization? And if so, what are the implications of this for policymakers, for investors, and indeed for citizens? How will these geopolitical risks affect global commodities, supply chains, the nuts and bolts of our economy? And how should policymakers, from central bankers to finance ministers, confront the major economic challenges that we see today, from slowing economic growth, soaring energy costs, persistent inflation? And so I hope we can get kind of a different take on these questions from each of our panelists. What I propose to do, in keeping with this slightly unorthodox economic outlook, is actually start with the politics, with the geopolitics. And for that, I want to turn to our resident expert, Sasha. And so why don't I open with a question that I imagine is on everybody's mind and has been really for the last month with the first anniversary of the war in Ukraine. What are your greatest concerns, Sasha, about the state of the war as we pass the 1 year mark? And really more pertinently, what are the threats both for NATO, for Europe, and for the United States that you could see mounting in the coming year?
Thank you so much. And I just want to say thank you. It's so wonderful to be here tonight in this amazing institution. Let me start by saying that beyond the human tragedy that's unfolding in Ukraine, it is, and it has been clear from the outset, that the trajectory of this war will essentially determine for generations to come the balance of power between authoritarianism and liberal democracy. The stakes could not be higher. And the invasion of Ukraine, and I think we do need to keep this front of mind, for the Russians, beyond the annihilation of Ukrainian sovereignty and culture and democracy, is part of a long-range strategy, which is essentially one to undermine the post-Cold War liberal order. And to do that by undermining the liberal democracies that underpin it, to reestablish that control over the would-be sphere of influence of Russia, and ultimately to undermine the values that won out, if you like, with the fall of the Berlin Wall. We have seen an almost, I think, miraculous response from the people of Ukraine to this atrocious aggression by Russia. And I would say an equally, although sometimes not sufficient, but equally miraculous response from the transatlantic community. 180-degree turnabout in German foreign security and energy policy. Extraordinary. The EU acting faster and in a more concerted manner than perhaps ever before. NATO expanding. I mean, extraordinary. Its moment in the sun. All of these things just couldn't have been imagined before Ukraine. And so in many ways, Putin has forged the transatlantic community that was fraying at the edges in many ways before Ukraine, has forged it in a way that we couldn't have imagined it really coming to life. But my concerns, one, with the US elections now, of course, ahead looming in 2024, and the potential of dramatic changes politically in the US, with the economic downturn resulting in part, of course, from this war. And we're going to hear a lot about the implications of that later today. But compounding the economic downturn, of course, that we've experienced because of the pandemic, and of course in this country because of Brexit, can we maintain the resolve? This is going to be the big thing. We're lucky we've had a warm winter, but can we maintain this resolve? Can we resolve this to the point that it needs to be resolved before the US elections would be my big concern, without having a clear understanding of what winning looks like. Nobody's really established what does winning look like for Ukraine at this point. The second big concern I have is around the information space. Information has been a central pillar of Russia's foreign policy and military strategy, and always has been, of course, the information war, the cybersecurity and information war accompanies the ground game at every step, and Ukraine has been no different. We keep talking quite bombastically about having won out in the information war. I think that we've done not too badly in Western context, but in our analysis beyond the West, that is not at all the picture. That picture is much, much less rosy. We see, for instance, in the MENA region, RT outpace in terms of viewership and engagement every single other regional competitor, from Al Arabiya to Al Jazeera to Sky Arabic. I mean, this is, and with it, they are succeeding. And by the way, the Chinese information operations that we're seeing, which are much more aggressive than we've seen before, mimicking some of that Russian information space, are again, that's corroborating those talking points, that's supporting those talking points, which are essentially reinforcing a sense of anti-Western sentiment that pre-exists, of course, at this time. So the picture is not at all, we're not investing in that global piece of the challenge, I think, sufficiently. So we're in, I think, tricky territory. Can we really make this, can we tip the balance in our favor by the end of this year is the question.
Just one follow-up before I move to the next topic, and that has to do with what you said a moment ago about how in the information war, if you will, the West has done okay, other parts of the world are in a much more vulnerable position. But I wonder what you make of the vulnerability of the United States going into this election. I mean, we all remember what happened in 2024 with the role of disinformation in social media, Cambridge Analytica, all the various issues, the leaking of damaging emails. How vulnerable is the United States 4 years on to the same kinds of interference and influence? And are you in a position to say today that you're relatively confident that we'll have a secure presidential election next year?
No, I'm not relatively confident. I think so many of the same problems exist, and we will have new ones. So just to give a sense, I mean, the hybridization of the information threat landscape has been really profound, and it means that we're facing a much, much bigger set of problems. And by that, I mean, you have the mutual reinforcement and amplification of a whole host of bad actors now. Hostile states, commercial bad actors, conspiracy networks on a transnational and domestic basis, extremist and hate groups are all reinforcing each other's narratives in support of this sort of pro-nationalist authoritarian perspective. All of that then hypercharged by the algorithmic architecture of social media platforms, which essentially promotes the stuff that comes closest to the red line, whatever it may be. So just to give you some examples, we found that in 2020, for instance, content that was promoting vote fraud. The idea of vote fraud got twice as many interactions on social media, across mainstream social media platforms, as the highest performing content that debunked that type of content. And you see that on every vertical, whether it's disinformation about COVID and vaccines or whatever it may be, or misogyny. That type of content is amplified. So you've got the dual problem of the reinforcement of bad actors in support of these anti-democratic forces of division, amplified by social media. We are seeing finally moves in Europe towards the regulation of social media, with the Digital Services Act at the EU level, with a bill here, which isn't perhaps as strong in the United Kingdom. There is still a lot of resilience, resistance to any form of regulation in the United States, though the conversation has shifted somewhat. We won't see, I think, that regulation in place on time to protect the election. We've seen an absolute uptick in foreign activity in the US. And again, because of the political landscape, because disinformation is ultimately seen as a political hot potato. We're seeing government not being able to address this properly, security services not being able to address this domestic dynamic. And the hostile states, they are piggybacking off the domestic conspiracy, hate, and extremism networks. And that's how they operate.
I want to pivot to the economy and the markets, but I want to keep that notion of bad actors in our hip pocket because I think it's quite relevant even in a market and economic context. I'm hoping, Jeff, you can give us a sense for how geopolitical shocks and instability play into the world that you look at, the commodities world, the world of supply chains. And one of the obvious big topics over the past 6 months was the soaring price of energy, the enormous fear that it might bring Europe to its knees over this winter. I think it's fair to say Europe did better, Germany in particular, than some people expected in weaning themselves off of a full reliance on Russian natural gas. Nevertheless, it seems premature to say we're through the great energy scare of 2022-23. But I'm just wondering whether you could sort of talk a little bit about how you think about geopolitical shocks in the context of commodities and the economy.
Okay. I first want to dismiss the idea of, the only bad actors use energy as a weapon. The U.S. used energy as a weapon before Putin did. And there's
explain that briefly before you go on.
He used the SPR.
Okay.
Strategic Petroleum Reserve, by definition, is a weaponized form of energy. Geopolitics clearly play a very important role in setting the prices of commodities. And what we're arguing, and deglobalization is a big part of that, decarbonization is a big part of that, and then redistribution or dealing with income inequality is a big part of the demand for commodities. In fact, we're arguing that we're entering a commodity supercycle over the next decade or so, similar to what we saw in the 70s and in the 2000s. Before I get in and talk about what the drivers of that supercycle are, which means, to answer your question, we're just at the tip of the iceberg. It's going to get worse as we go forward. And really at the core of it is what we call the revenge of the old economy. We have not been investing in old economy output for well over a decade now. Why? Because returns were poor, and we redirected the capital into the new economy, which is why we call it the revenge of the old economy. But with that backdrop, I want to just go to the genesis of the problems in Europe so we really understand what happened. And I want to start with China. And I want to start with, I know a lot of people remember, it was around January of 2021, the world got really green, including China. Remember, they announced their big 5-year plan on decarbonization. So their immediate response was to cut coal output. And since deglobalization is a key theme here, I want to say decarbonization and deglobalization are very similar. Carbon is portable, electrons aren't. And so in cutting that coal output, they cut power, they cut steel, they cut alley. Now Europeans and Americans got to kick up their aluminium production on the side of the Atlantic, and steel production, which burns more energy to offset what the Chinese were no longer exporting. But the key is they took in a lot of the world's LNG. And LNG is liquefied natural gas. It's floating natural gas. You have to basically liquefy it, which is freeze it first, and then you put it on a $300 million floating thermos. I'm not a big fan of the technology, and you move it around the world. And so the Chinese took a lot of this LNG in lieu of shutting down the coal production to get, by the way, they're reducing coal not so much to fight carbon emissions, just fight pollution, smog and the acid rain problems that the Americans and Europeans fought in the 1970s. But you get that's the setup. Okay, so let's shift over to Europe, and that's the summer of 2021. In Europe, there was not a focus on reliability. Because remember, if you invest, and again, the policy and the politics in Europe were to install as much solar and wind as you possibly can, renewables. But the reliability of renewables is not that great. You got to depend upon the wind has to be blowing and the sun has to be shining. Well, what happened that summer? The wind quit blowing by 20%. That's a huge shock in commodity world. That's a world-class supply shock. Okay, now Europe has not been investing in gas or oil because that's the revenge of the old economy. Now they go to the world to try to get that gas. The Chinese had taken all the gas. There's no gas. Now Putin is sitting there looking at that going, here's my opportunity. They have no gas, they have no wind, and China's taken up everything else. So he starts amounting troops well after it was clear there was an energy crisis. He starts amounting troops on the Ukrainian border in October of 2021. The reason why I want to go over this is let's get the cause and effect right here. Did Putin cause the energy crisis? Absolutely not. He took advantage of the energy crisis. The energy crisis, the problems, the seeds were sowed on this going back well over a decade. So let's talk about what that means going forward is that, and by the way, Putin wasn't the smartest. When he did his first attack in April and pulled back oil supplies, that's when the Shanghai lockdowns happened in China. There's no pressure on the system. Then he does the gas again in August, and then remember, there's the reversal of zero COVID policy, China collapses. And this is one thing, all these macroeconomists go, oh, we're worried about a recession in the US. News alert, the world's largest commodity consumer, the world's largest oil importer, the second largest economy in the world just shut down. Now I'm Putin cutting back everything, and there's no pressure in the system. So let's not dismiss the importance that China has had in this entire role. Okay, I'm going to say, yes, the Europeans, conservation efforts dropped demand by 15 to 20% for each heating degree day over this winter, which was huge. And then you had a cooperative winter. One thing we were saying, back in October was nobody gets hit by the train they see coming. And they didn't. They built up inventories. They survived this winter, but you still have the underlying problems that are associated with this. So let's take a step back and talk about what is a commodity supercycle so you understand why this is not ending anytime in the near future. And essentially what a commodity supercycle is a CapEx cycle. What was the big 1970s? It was a huge CapEx boom. Just look at CapEx divided by real GDP, and it goes straight up in the 60s, late 60s and 70s. And it did again in the 2000s. And you can think about this is people ask me, well, won't higher interest rates kill off the investment in commodities in this commodity supercycle? The answer is no. The higher interest rates are telling you, put money into the real world today, get it out of the financial world. When interest rates are zero, all you care about is pie in the sky, long duration stuff. Which, by the way, I'm going to put ESG, green tech, hydrogen, all into that bucket that in very low interest rates, they look great, which is part of the reason why the Europeans got themselves into the problem that they had. Too much investment in these very long like duration type energy assets, not in the stuff today. And when we look at these, and it goes into deglobalization, everything. Why was the 70s a huge capex boom? Building up military. You had a Cold War going on. You actually had the war on acid rain. We had to desulfurize everything. You had the war on poverty with LBJ. So those big capex cycles are what we're going into. And so when we think about what these shortages amount to, the U.S. I'm going to just run a circle, the east of Rockies area of the US. They have shale, and it protected them substantially in this fire. California is just as exposed as Europe, and same thing with Latin America. So it really is that east of Rockies area in the United States that's safe. Everywhere else is very much exposed. I just want to finish on the point about the underinvestment. What we have seen because of the the geopolitical risk out there, because of the rising inflation, real capex, whether if it's oil, metals, gas, food, all of your core commodities, they've actually gone down over the last year. So the high prices aren't creating any more supply. One more point about the underinvestment. What they're all tied to is carbon. I want to emphasize, I'm the biggest advocate out there. We need to solve climate change and deal with it. But I'm just going to point out some stuff in the discussions today that I think are important. Is fossil fuels are what we call hydrocarbons. They're a CH. Carbon hydrogen is really what makes planet Earth. That's that portable muscle that allowed globalization to happen. What is food called? Food is called a carbohydrate. It's carbon as well. They're both CH bonds. The difference between food and fossil fuels is only an oxygen. You want to fly to Mars, you got to figure out to swing that oxygen in and out of what you eat and what you put in the rocket booster. But the point being is everything in that category is severely underinvestment right now. That's why food prices were going up in 21, gas prices, oil prices. And so when we look at the outlook in 2023, your starting point is no inventories of most of these commodities, no spare production capacity of most of these commodities. And let me repeat, the world's largest commodity consumer, the world's largest oil importer, and the second largest commodity consumer in the world doing that. It's going, recovering at a very rapid pace. And PMIs last week came out and showed factory activity in China the highest level since 2012. So what's likely to happen, whether if it is oil, gas, food, or any of these carbon-based commodities, demand's going to catch up to supply again, and we're going to be right back into the same problems we had before.
Is all of that a way of saying that Putin's timing may have been bad when he last tried to weaponize gas prices, but if he tries it in the coming year, he's going to have much more success?
But for gas, he can't do it anymore because he blew up the pipelines in the process too. So, by the way,
somebody blew up the pipelines.
We were playing today. By the way, there's four pipelines there. They're Nord Streams 1 and 2 and Nord Stream 2, 1 and 2. The only one that wasn't blown up was the one that the Germans stopped for bureaucratic reasons. You make of that observation with what you want on that. But I would argue, I think you're spot on. Does he try it with oil? Because remember, the Wagner Group is down in Libya. It's in, it can go into Kazakhstan. I think the reason why you haven't seen him do anything is he's looking at China. By the way, China, you can see it. Bob just pushes them around in the pricing on oil. The central bank was selling RMB and buying, it was selling RMB to buy its own rubles. It means it's short, which is telling you that they're not getting revenues, and the Chinese are pushing them around. Gotcha. So we'll see what happens as the Chinese demand recovers. They're back in the driver's seat. And I would tend to think it starts to get pretty asymmetric because that risk shifts when a tight market whipsaws back his direction pretty hard.
Okay. Thanks. So with that kind of a scenario, Randy, I wanted to turn to you and ask the question, you're a central banker. You're either Jerome Powell or his counterparts in Frankfurt or London, and you're looking at inflation that's proven to be stickier than maybe you hoped it was, and possibly will continue to be bad for all the reasons that Jeff has laid out. You're in the US looking at an economy that's actually cooked along, because perhaps better than many people predicted, not so much here and perhaps in Europe. What do you do as a policymaker? How much control do you actually have over events? What are the levers you can pull? And have policymakers shown they've been able to do so in the first phase of this period?
Sure. I mean, this is an incredibly challenging time for policy, and that's why it's a particularly great time for us to be doing a political economy focus rather than just a traditional economic focus. Because so many of the important, there's a lot of focus on what Jay Powell is doing, what Christine Lagarde is saying. They certainly do have very important levers, but the biggest levers are with President Xi and with President Putin. Those are the ones who are potentially making very big decisions that everybody else is responding to. I mean, in traditional terms and in kind of everyday moving along, certainly it's the central bankers, but ultimately the choices that these geopolitical actors are making are of super great importance. Now, the commodity, the high inflation that we saw came before the war. So that was, I mean, some people said, well, it's a global phenomenon, it's just something to do with the war. Certainly the things that Jeff was just talking about exacerbated the issues, but inflation was rising in the US and then globally everywhere for a year, at least a full year before the war started. And so that really was a policy choice that was made in the US and in other countries. You had this very strong initial response to COVID on both the fiscal and monetary side, totally reasonably, shutting down the economy, incredible uncertainty about what the health effects would be. And so having a stimulus that was on the order of 6 times what we had done when I was at the Fed during the global financial crisis. People were rending garments over thinking about $1 trillion, maybe getting towards $1 trillion fiscal stimulus. Well, that was done, 15% of GDP, 3 trillion was done in the US, when of course, no one could possibly agree. There would never be, Trump would never agree with the Republicans, even some of the Republicans or the Democrats. But one thing, unfortunately, that a lot of politicians can agree on is to spend more. And that seems to get a lot of support. But I think that was perfectly reasonable then, and a lot of countries spent about 15% of GDP. At the same time, you got a very strong monetary stimulus that came in. Again, much stronger than when I was at the Fed from 2006 to 2009. And again, perfectly reasonable given all the uncertainty. The issue was that these things continued on. And so you had multiple rounds of stimulus, another round of stimulus in December just before Trump left, then another round of stimulus under Joe Biden, direct stimulus, and then other spending programs. The Fed, after responding to a glitch in the US Treasury markets, quite reasonably started buying assets, extremely important to provide that support. But they continued to do so at a rate that was astonishing compared to what we had done in the past. And they were really responding to a financial issue that they resolved. They really didn't need to continue to buy assets at the rate they were buying, but they kind of got themselves into a bit of a commitment to continue to do this as long as possible, to make sure the markets calmed, and so it was harder for them to pull back. And so that's one of the reasons why you saw the inflation take off in the US a little bit before other countries. But other countries also had a lot of stimulus, and then a lot of price pressure, and then you had the war in the Ukraine also destroying some of the supply issues, pushing up energy prices in the short run. And so that's one of the challenges now. That's why central banks have been running to raise interest rates so rapidly, because they don't want to lose credibility. Nobody wants to have the 1970s rerun. I was doing a Bloomberg hit, and And this is like 6 months ago when I was saying that, interest rates could get to 4 or 5%. And people were just saying, that's insane. They can't get that high. And I reminded the person who was asking me the questions that, well, last time inflation was this high 40 years ago, interest rates were double digit. And, if you could get a mortgage at 12%, you were really happy. And the response from the presenter was, oh, well, my mother told me about that. So I said, well, maybe you should listen to your mother. Maybe she has something to say to you. And this has, I think, been one of the issues with what's happening in the markets and happened again today with Jay Powell's testimony. Jay Powell has been, since July, the message has been super consistent. And really since the fall, from the entire body, every speaker from the Fed saying exactly the same thing over and over again. But the markets keep getting surprised when he repeats it. And I think part of that is because it's been generations now since the Fed has done and central banks have done what they normally do, which is take the punch bowl away when the party really gets going. Labor markets are incredibly hot, continue to be very hot. We see, price pressures in a lot of different markets, some supply constraints. And so the Fed is trying to take the punch bowl away. Other central banks are trying to take the punch bowl away. Interestingly, it's not working like it usually does. The labor market is still very, very strong. And basically, until the labor market quits, the Fed is not going to quit, and other central banks will not be able to quit either, because there's still going to be these incredible pressures that are there. The challenge is, will they go too far and push us into a downturn? The labor market, I don't see how we can tame inflation without the labor market softening. They're hoping for what I sometimes call an immaculate disinflation, that we can bring down the inflation rate without bringing up the unemployment rate. Is that possible? For sure. We've never seen it before, so I don't think it's a high probability event, but it's possible. But it'll be very interesting to see what the labor market report is this Friday, and then we get another inflation report, because that'll determine whether the Fed is going to go 25 or 50 basis points at the next meeting.
You said something earlier that caught my ear. You said that what Jay Powell says and does, or Christine Lagarde, may matter less than what President Xi and President Putin do. But you didn't say Joe Biden. Was that an intentional omission, or does the US government in fact have levers, things it can do fiscally that could be as meaningful in a different way than what Xi and Putin do?
I was thinking more in terms of the, particularly with Putin, with the war and escalation in the war, and then obviously there are these geopolitical issues. I mean, tensions over Taiwan. There are also, I didn't mention it, but there are an enormous number of tensions in the Middle East. It doesn't get that much coverage, but there's been an ongoing war in Yemen for a very long time that continues to be there and is dividing a lot of the people in the Middle East, the different countries in the Middle East. There's a potential for a lot of tension between Israel and Iran, given that reports are that Iran is moving ahead in its nuclear program. That is extraordinarily volatile, and those are the big things. That's what I meant more by that, rather than certainly on the monetary and fiscal side. The U.S. is very important. They can do good things. They can also do problematic things. Obviously, as I said, we kind of maybe went a little bit too far and got some of the inflation that we're trying to pull back from now.
I'd like to now, if I could, go back to something that Jeff raised earlier, which is this whole notion of deglobalization. Jeff started off by putting it in the context of commodities in a way that I hadn't heard done before and was interesting. But obviously, deglobalization manifests itself in nationalism and extremism and authoritarianism. And I just wanted to ask, to bring it back to Sasha for a moment, as you think about the whole concept of deglobalization, from the way you look at the world, how do you sort of see deglobalization playing out? Do you see a kind of an uneasy peace between a series of big blocs that may be built around the US, the EU, and China? Or do you see something more anarchic, more dangerous? Ian Bremmer sometimes talks about a G0 world, which he doesn't mean in a good way. So I just wonder whether you would address how you think of deglobalization. And after that, then we'll go to the audience and take some questions.
Yeah, it's a really interesting question. I mean, there were sort of two common assumptions that I think have borne out to be essentially untrue, that were sort of globally acknowledged as a sort of the direction of travel in the 90s. And that was one, that liberal democracy was the best way to deliver on economic growth and welfare. And the second was that economic interdependence would result in peace. And here we are, of course, in an era where we've seen the rise of rich autocracies and therefore a competing model of governance. And we've seen that this interdependence, in fact, puts us in an extremely weak and vulnerable position. And of course, the elephant in the room is China on that front, not Russia, actually. So this is just the beginning, I think, of a reckoning. And so, and here we are, of course, with an international system in which we see a rogue nuclear state sit on the Security Council of the United Nations. The whole thing starts to feel like it just can't hold anymore. So this question of what comes next, and the rise of authoritarian nationalism, which is really the sort of the intersection of all of these bad actors, drives in that direction, and we're seeing things tip in that direction. Even in and around issues like climate. I mean, it's interesting watching things like climate disinformation play out. The narrative is no longer climate denial, climate change denial. The narrative is really about how we don't want to see transnational, internationalist solutions, but we need nationalist solutions to the problem of climate. And I think that narrative is what we have two options, I think. We either really rally around the idea of an alliance of liberal democracies and really, really invest in that in some shape or another. And there are a number of proposals around, and that it's important that we understand those alliances, not just on security lines, but on economic, on technology, on information technology grounds. I mean, we have to start to build the infrastructure, the institutional infrastructure to support human rights respect and liberal democracy worldwide, or we will lose it. We will simply lose it. The alternative is essentially a form of anarchy. The fact that the EU has managed to finally get its act together, I mean, extraordinarily around Ukraine, is something I think of an indicator of the possible. And I would hope that we can really look at this Ukrainian catastrophe as the turning point. If we don't use it as the turning point, we will lose democracy, and we will likely be, if not in an anarchic state, in a global in a global context which is dominated by China ultimately. And I think that's an extremely dangerous place.
I've got a lot of interesting questions that touch on various elements that we've covered, but why don't I throw one right back at you, Sasha, because it's very pertinent to what you just said. Here's the question. Isn't the European response to the invasion of Ukraine more fragmented than united? With the notable exceptions of Poland, the UK, and the small Baltic states, support for Ukraine has come in dribs and drabs, and with increasing reluctance to, quote, go the distance. Is this situation viable?
Yeah, I mean, you're right, it's not sufficient. We'd like to see more. It needs to be more if we're going to get the resolution that we need on the ground. By the way, the settlement of this conflict will ultimately play out on the ground militarily, not through negotiations. And now we know that we have a limited, I think, period of time within which to make that settlement happen, while the United States is, firmly in support of an outcome in favor of Ukraine. That could change. And so the Europeans, the United States, they need to get their act together now this year. We may not have 2024 to do this. It couldn't be more important. I agree. I think the resolve may falter. We need to do better. We do need to invest in making sure that the disinformation, which is targeting all of these societies very, very heavily and is in fact quite impactful. So burgeoning movements in places like Germany that we see around a kind of so-called peace movement, which is essentially about a negotiated settlement that isn't in the interest of Ukraine at this point. these kinds of ideas are being sown and amplified by Russian disinformation. We must do a better job of making sure that that doesn't get across, but we have a small period of time. I'm not sure we do a good enough job of explaining quite how existential this battle is, not just for Ukraine, but for the future of democracy, for the future of freedom. These are things that we need to be explaining to publics in a bigger way. But it's hard because the other part of this is that, you know, the biggest sort of predictor of people's frustrations with democracy is the extent to which they believe democracy is not delivering on on economic grounds. And so we're here in a sort of something of a catch-22 as we're sort of feeling the pinch of this war from an economic standpoint. We're also seeing rising frustrations about democracy and its ability to deliver. So again, time is of the essence. I think we have a year in which to make something definitive happen here.
For percent. I think there's going to be a very important interaction there going forward. It may also be true in Europe if the unemployment rate goes up significantly. So, you know, if the labor market does crack, which is in some sense where central banks are trying to go, they feel that they can't get inflation down without a significant readjustment. But if it does get into some recessionary territory, I think that's going to have a very big impact on for this, and some of that unity may fray.
All right, let me switch back to more economics and is I had to smile in light of Jay Powell's testimony this morning. Where do you think the Fed funds rate will peak? I'll let you peer into your crystal ball, and then but more sort of substantively. Given this complex economic situation we find ourselves in, are there any government interventions or unconventional policies by central banks
you get another like incredibly strong labor market report, so no suggestion that the labor market is slowing down, that's likely to lead them to go further. We'll get another inflation report, and inflation, it's come down off its peak, but it's going to be bouncing around. It's not something that's going to just go straight down. And also there'll be a lot of variations in the energy markets, commodity markets. It'll be bouncing things around over the next year. So it's not just this simple thing. Oh, they've turned the switch on to they turn the air conditioning on to bring some of the heat out, and then the temperature will gradually come down. It's not that simple. So I think I've been saying for a while that I think they're going to end in sort of the mid fives. In the U.S. they're at 475 now, or 450, 475. So that means roughly 3/4 percentage point more than where they are. But it could, if the labor market doesn't slow down, they could easily move more towards 6. I think it's most likely that it'll be somewhere in sort of like the 5.5, 5 3/4 region. But if the labor market doesn't slow down and inflation doesn't slow down, they'll continue on. Are there additional levers? I don't really think there is that much that central banks can do. There's a lot that they can do to respond in a crisis. So like when there was dysfunction in the US Treasury security market, the Fed came in, bought securities, stabilized that problem. Those are COVID came, they did all of the programs that we had pioneered when I was the Fed during the global financial crisis, plus a whole lot more. But those aren't ones that are going to be dealing with these issues. I mean, if there's a supply chain issue, the Fed can't create chips. They can't drill oil for oil. So they can't do those sorts of things. And so unless there's a financial crisis, they really don't have the tools to do much more right now. One thing that potentially could do, and this came up in the testimony today, is that some of the senators said, well, you're doing too much. Let's take a pause. What is this? Talking about another 25 or 50 basis points. Man, you've been on a tear over the last year. So why don't we sort of see what the consequence of that is? Now, they didn't explicitly say this, but they all have in the back of their mind Milton Friedman, a great University of Chicago economist, famous phrase from literally 70 years ago, which is still totally relevant today, that monetary policy has its impacts with long and variable lags. And so we don't know exactly how long it'll take. Maybe they have done too much, but it'll take us another year to figure that out. But I don't think we have the luxury of waiting to see. I think the Fed does have to make sure that inflation expectations don't get out of control. That may mean that we will have more of a downturn in the labor market. But the labor market has just been so strong in the U.S. as well as elsewhere, throughout the entire region, here in Europe, Middle East, Africa, that it's I think would be really inadvisable for central banks to say, okay, we're just going to take a pause now, and maybe things will get better.
I want to throw a question at Jeff, who talked earlier about the commodities supercycle, which sounded pretty cool, at least if you're in the commodities business. So the question is, with all the doom and gloom and uncertainty that we've been talking about on this panel so far, do you see any distinct silver linings when we talk about US-China relations, China's relations with the rest of the world, and even domestic US politics in the coming election?
When we use the word deglobalization, it has different meanings. It can be political, it can be cyber, it can be trade. My world deals with things, widgets moving from A to B, so I use it in that term. But you go, where do you want to be invested in this? I mean, the core of this CapEx cycle is going to be around decarbonization. We've got to change the way we do transportation, manufacturing things, heating and cooling ourselves. We've been doing it for 250 years. You got to reverse it. We estimate it's going to be the CapEx requirement this decade, the size of China was in the 2000s, and then next decade is 2 Chinas. So if you thought China was bullish metals and everything in the commodity space, this one's going to be even that much more bullish. Now, I'm not going to call that a silver lining, because the costs are going to go up tremendously. And when we think about, we don't know if these technologies that we're going to plow money into are going to solve this problem. All I know is I'm pretty comfortable saying, and I think that the US government's underestimating the size of the IRA. And now Europe's doing their Repower EU in place, and this thing could be trillions of dollars. And why not? 30%, they'll give you 30% of the cost of a green hydrogen plant. That's a pretty good opportunity, and that's going to create a lot of demand. Now, I want to go back to geopolitics and bring it in and talk about deglobalization. It's in our DNA. We know how to do environmental policy and do it well. We did it with desulfurization in the 70s. That's called the war on acid rain. We got all that sulfur out of there. And by the way, I'm not going to say getting carbon out of the fuel is easy as getting sulfur out of the fuel. It's a lot more difficult problem, but the politics were much better. We had carbon markets, carbon prices. And I imagine there was some guy like me sitting on some stage in 1965 going, it's going to cost trillions of dollars to desulfurize the world and get rid of the acid rain. It didn't cost much at all. Why? Once you put markets and they started working, venture capital went to work, technology solved the problem. And voila. And here, there was another important point I'd like to ask people this is, you remember when Volkswagen got busted with the catalytic converters, 7 or 8 years ago? Does anybody know what Volkswagen paid? Answer's $20 billion. Nobody in Germany will ever turn a coal plant back on if you're going to find them $20 billion. You have to get to that point. And you can't dictate. Now I'm going into an area that I'm just going to make this statement, and I am not trying to say anything political on it whatsoever. Is the left, call it Labor, Democrats, whatever it might, does not have a very good track record of creating successful environmental policy. And what is IRA and less Repower EU? They're picking technologies. Now, the right, Richard Nixon, you have Thatcher, Reagan, they all successfully implemented environmental policy. And what did? They didn't pick the technologies. They let the engineers figure it out. And so, let's say the silver lining, right now, we're geared 100% through IRA and the rest of them. And we're doing solar, wind, hydrogen. By the way, it probably works. It's going to be really expensive, create an enormous pull on global resources, but you're going to get there. Maybe we still don't know if the green hydrogen actually works, and the battery technologies are still iffy. I think we'd be better off if we, that's the Chicago view of the world. Let the markets and the venture capitalists figure out how to solve it. But one last point on the deglobalization, because you think about really kind of the problem is there's too many views on too many different things in the current world of globalization. In the 70s, when we solved the war on acid rain, there was just two worlds, the Soviet world and the American world. It was pretty easy to negotiate the deals. And it was the Soviets and the Americans that solved the acid rain problem. They were able to wrap up in a nuclear treaty the rules and regulations around desulfurizations, lay down the laws, jammed it through Warsaw Pact and NATO countries, hence why Volkswagen was complaining of the rules 20 years later. But the point being is you created that rules and regulations that are critical to solving the problem. Right, that sticks. You're hitting everybody with sticks. Right now, we're all carrots. So to answer your question, actually a Cold War type environment created the way to create the sticks that solved the problem before. But if you're looking for good investments and you want to make money, the IRA and the carrots, just follow that carrot like the donkey, just don't get caught in getting crushed in the cost basis.
Okay, we have about 10 minutes. So I'm going to actually just jump around and throw a few questions out a bit randomly. And one, I guess either for Randy or Jeff, how will the crypto economy make things worse or better than they are now?
Start with that? Or do you
want me to start? I
Go
got
for it.
strong views on that one.
Sure, why don't you start?
Crypto is essentially a commodity because it's not a claim or a security. It doesn't have a contingent claim to it. But it's no different than green hydrogen. It doesn't do anything today. It has a cash flow that's almost zero. In a 0% interest rate world, it's fabulous. In a 5% interest rate world, it hurts, it struggles. And I really watching about these commodity super cycles.
Mm-hmm.
What was the 1960s? Low and stable inflation in the Nifty 50. What was the Nifty 50? Coca-Cola. It's like LVMH today. Brands, crypto, green hydrogen, it's all the same stuff. It's just doesn't give you cash flow today. It's something way off into the future. What happened? And then along came LBJ with his Great Society, and you're off to the races in the 70s. What was the 90s? Low and stable inflation. What do investors chase? They chase .com. And what was .com back then? Is Microsoft, Amazon. What was the 2010s? Low and stable inflation. What do investors chase? It's the same duration stuff. This time it was FANGs, crypto, green hydrogen, all of that stuff that is, call it pie in the sky. All I'm arguing is today, we got to deal with the real world problems, whether they're political. By the way, carbon emissions are going up. Nobody at 0% interest rates, you don't have to make choices. And crypto is no different from the rest of that. So today we need to make choices. We have to deal with the stuff that is relevant today, not the stuff that's relevant tomorrow.
We've been talking, I think primarily we'll agree about the G7 and the developed world when we've had this conversation. One of the questions is, I think a pretty good one. What would you do if you were the finance minister or the energy minister of a developing country in this environment?
I think
Randy, you want to jump in?
Well, obviously it depends on whether you're an energy producer or not.
Of course.
And so obviously, if you're an energy producer, taking advantage of and have the ability to try to get some of the investment or use the investment that you have to draw more of the resources out, draw them out now because prices are high. There's a lot of demand for that. And it's also been very interesting to see Biden talked both about, he's castigating the traditional hydrocarbon producers for a long time, and then castigating them for not producing enough. And so, it's sort of hard to kind of get it both ways. But I think, getting doing that now, trying to see if you can get an environment where you can get as much investment as possible relatively quickly. It's been amazing to see in Germany how quickly they were able to build an LNG plant. I'm sure you know more of the details on this than I do, but I've been speaking with some of the people in Germany. And so something that normally would have taken 18 months to 2 years was done in 6 months. And that's because instead of having 6 levels of permitting, they agreed it would just be one permit. And so if it's permitted at the federal level, you're off to the races. And so it's really amazing that if you put your mind to it, you can cut through an enormous amount of red tape and get things done very, very quickly. And so I think that's the same kind of thing in emerging markets where there tends to be a lot of red tape, a lot of inefficiency. If you can get that focus, that can lead to higher employment, that can lead to more resources that can be used down the line for investment to green things down the line. But you want to try to use the resources that you have now to provide those resources into the global markets.
Let me just ask a last question. I'll give each of the three of you a crack at it. Please keep your answers brief. What is the panel's view on political risk in the United Kingdom and the United States? Sasha, you start.
Oh, goodness. The good news is that the UK is no longer really relevant to the rest of the world. And so the risks that we face here, less of a problem. The US, of course, is a very different question. And I think all of the vulnerabilities that we discussed earlier in relation to this forthcoming election and more, new emerging technologies that aren't really being baked into the way in which we're looking at risk, from AI to blockchain to other types of things that bad actors are looking at using alongside just some of the old stuff. The big lie has not gone away. We now see in polls that both Democrats and Republicans, 40% of Democrats and Republicans would be willing to use violence in certain contexts. That's up from 10% just 3 years ago. So you're looking at a highly radicalized, polarized environment. If we lose the US, we lose in many ways the rest of the world. So I think again, the stakes are very high here. And we all need to be more cognizant of how the way in which we articulate the challenges, economic, political, security, to voters, to the electorates, impacts ultimately the peace and stability of our countries and of liberal democracy long term. We have to do better at that. That's going to have to come from business. It's going to have to come from government. It's going to have to come from media. We're going to have to rebuild trust with many of those institutions that have plummeted in terms of the trust that they used to have.
Jeff, and then Randy, and you each have about a minute.
All right. I'm going to go back to the question, what would you do if you were a policymaker? I would levy a carbon price, carbon tax. Something. You need a price carbon immediately, because therein lies the problem. And let's go to the civil unrest question. Civil unrest is income inequality is off the charts everywhere in the world, even in places like China right now. It's the highest level since 1920, the previous peak in globalization. What's going to make it way worse? All of the decarbonization, because who's going to pay for it? Who has a bigger share of their carbon in their budgets? Low income households. I don't care if they're United States or wherever they are. And now you got to ask the question, who's going to pay for that, trillions of dollars of IRA and Repower EU and the rest of it? It's going to aggravate it and it's going to make it worse. And so, kind of it's one and the same question. We need to deal with this carbon issue quick. And the only way you deal with it, put a price on it and move on, just like we did with sulfur in the 70s.
Gotcha. Randy, bring us home.
I think it was a little unfair on the UK. I mean, I think UK,
Thank you. As the London bureau chief, I appreciate this.
Well, no, I think they took a very strong leadership position on Ukraine, and I think that was very important for the rest of Europe as well as for the US. So I think that something that shows there's still a relevance there. But I'll focus my other response for the US, and I think it goes back to what we were talking about before about if the US economy does turn down, and that starts to raise very significant questions about support for outside of the US for our global engagement. Do we want to be supporting, sending those tens of billions of dollars to the Ukraine? It's, as I said, very, very different if the unemployment rate is 6% than if it's 3.4%. And so I think that's going to be one of the big challenges. And I think it's very important that, for the reasons that you articulated, that the US not give up on its resolve to stand up to authoritarian regimes. But I can also understand that, particularly during a political cycle, with the unemployment, if the unemployment rate is rising, that resolve may weaken.
Jeff, Sasha, Randy, I thank you very much. And I'm now going to hand over to Dean Rajan, who's going to make some closing remarks before we adjourn. Dean?
Thank you. Thank you, Mark. My thanks to all of you for joining us this evening, both in person and virtually. It was great to be able to host our first hybrid economic outlook EMEA in our spectacular new Rothman London campus, and especially meaningful for us at Chicago booth to share the event with our partner, the UChicago Institute of Politics. Thanks again to the fantastic panelists, Randy, Jeff, and Sasha, and to Mark for moderating an incredible conversation. So this concludes the 3 economic outlook events that were based out of each of our global campuses. I encourage you to visit our website, chicagobooth.edu, to learn more about the previous EOs, the ones we had in Chicago and in Hong Kong. Now, many of you know that this is a key year for the school. This is our 125th anniversary as an institution, and we're celebrating this in a number of exciting ways, hosting special events through the year across the globe, featuring alumni, faculty, staff, friends, and many, many leaders from the business community. One special event I want to mention, particularly since you're in London, is the kickoff of our first faculty in residence program on the Rothman London campus, featuring Raghuram Rajan, the Catherine Dusak-Miller Distinguished Service Professor of Finance at Chicago booth. That event is going to be held on April 18th, and it's titled Beyond the Annual Report. And registration for that is going to be opening soon, so please stay tuned. Once again, on behalf of Chicago booth and the Institute of Politics, thank you all for joining us tonight for Economic Outlook. Have a good night.
So for those of you here on campus, we invite you to join us on the first floor to continue the conversation at our networking reception. And thank you again to our panel and to our